Thanks for listening to Investor Insights, a behind-the-scenes look at investing with Fund That Flip. This series provides an insider's look at how our business works and answers your frequently asked questions so that you can make better investment decisions with your hard-earned capital. Now, our founder and CEO, Matt Rodak.
Welcome to this episode of Fund That Flip's Investor Insights. I'm your host, Matt Rodak, founder and CEO here at Fund That Flip. And today joining me on the show is a very special guest, Peter Lowden, who is the Managing Director and Portfolio Manager of Prime Meridian Capital Management. And Peter will be giving us some more details soon, but at a very high level, Prime Meridian was one of the very first institutional investors in the peer-to-peer lending space way back when that started, probably over a decade now, primarily buying consumer credit. And over the years, they've grown their strategy to include other assets, which now also includes real estate. So, I know on our platform alone, they have well over 100 investments. I'm sure they've made hundreds more on other platforms. And this is all to really say that Peter is a wealth of knowledge when it comes to investing in this asset class. And he's been kind enough to join us today to impart some of that knowledge to all of us. So with that, welcome to the show, Peter.
Thanks, Matt. Nice to be here.
Yeah, so awesome to have you here. So maybe before we jump into some of the details around your guys' strategy and how you think about the space, if you could maybe just give us a little bit more background on yourself and more generally PMI and what you guys are up to.
Sure, absolutely. So I have been in the investment management business for about 30 years now, if you can believe it. It's hard for me to believe, and it's been in multiple different facets, but largely associated with alternative investments, ranging across multiple asset classes. A few years ago, 3.5, I think it is now, met Don Davis at a conference and started comparing notes and talking about how online lending was disrupting the lending environment, and was something that sounded very interesting to me, very challenging, and lots of opportunities. So joined Don, and we have continued to build out Prime Meridian Capital Management, which is a roughly $600 million private investment firm focused on managing a family of private credit funds.
Got it. Okay. So about 600 million AUM spread across a number of different strategies, real estate being one of them. And I think, up until, I think you said around February 2016, you guys were primarily doing small business lending, consumer, decided to get into the real estate space. Maybe talk to us a little bit about that decision, why you like the asset class, and kind of what the perspective was that led you to go in that direction.
Sure. So, like you said, Prime Meridian was started with consumer lending as that space was disrupted by Lending Club and Prosper primarily. A few years later, we saw the same kind of thing happen in small business, and with Funding Circle and Biz2Credit and others also offering online origination and the opportunity to invest in those assets. And we had been tracking other verticals such as real estate. And we just felt like in early 2016, the opportunity was ripe to be able to build out a properly constructed fund, given what was available at that time. And we started out in February of 2016, so it's been a little over 3 years now for our real estate fund. And it's really just a logical progression of the evolution of technology being applied to investment markets that are now able to be accessed in a way that enable us to create an excellent portfolio.
Got it. So somewhat of a natural extension, I agree, and something that we kind of have seen and been fortunate enough to be a part of as well. Was it? I'm curious. Was it driven by like your investor base saying, "Hey, like we'd really like to get exposure to this asset class"? Was it driven kind of internally as you were looking for other ways to kind of grow your business? Like where did was it a push or a pull, I guess, in terms of, you guys ultimately deciding to go this direction?
Sure. No, it was really more internal.
Okay.
We saw the opportunity as far as the risk reward, similar to what we'd seen in the other verticals when those funds were launched at that time. So we just sort of applied that same formula, if you will, to what was at that time, the real estate bridge lending market. And, it's just been a successful blueprint that was executed in a timely fashion where we were able to probably be a little bit of an early mover relative to other people. And I think that's because of our experience with online lending generally. We kind of saw the evolution kind of passing through and saw the opportunity with real estate lending. And, in all of our funds, we use multiple originators just as part of our overall risk management approach. And we felt like there was multiple originators in 2016 that kind of fit the bill, that would pass our due diligence, that would be able to, we would be able to buy from consistently to achieve a high rate of return with, being able to manage the risk.
Got it. So when you guys are looking at this, you must have seen, you say positive risk return, now you got to go out and kind of sell the LPs on it, right? What were some of the reasons that you guys thought that the asset class made sense? And was your initial thesis kind of, has it proven to be true? I'm sure it's evolved a little bit, but what's ultimately, other than just, good risk, good reward, what are some of the things that you guys really like about this particular asset class from your perspective and from your LP's perspective?
Sure. Well, it's the collateral, right?
Yeah.
I mean, in the other verticals, you're unsecured typically or lightly secured. In this case, we are doing first lien only, and we're doing it at a nice margin, LTV of 75% or less. And so that was very attractive. We felt like we could get the same risk-adjusted returns, but with the collateral. So, it was, again, within the context of those, of the other experience that we've had, that it really was kind of a no-brainer.
Got it. Collateral is nice. A lot of people like the short duration. I don't know if that's good for a fund like yours because you're constantly, trying to recycle the capital, but I guess that's probably something that I would imagine the LPs like as well.
Yeah, I think, that's a good point. Short duration is always welcome. So everything we do pretty much is high yield, short duration.
Yep.
So it kind of fits the wheelhouse in that regard. And yet you also had the collateral. So yeah, for sure. That's definitely one of the characteristics that we look for.
Yeah. And you mentioned something that kind of, I think, is worth mentioning to the listeners. And just so everyone's clear, Peter is an institutional investor, but he and his firm invest alongside on our platform with our retail investors. And you mentioned something about, working with multiple originators, but, a handful that can pass your due diligence process. And I think this is something that, as we got onboarded with you guys, we looked at it as man, this is a real benefit to our retail investors, because these guys are doing a lot of the work that, an individual investor may not either have the capacity to do or it doesn't make sense from an economic standpoint to do. Maybe just talk us through it again at a high level, what you guys are looking for at the originator level from a due diligence process, in terms of getting comfortable with turning someone on.
Sure. So this applies to all of our originators that we use. Basically, we look for those that have experience, both the individual management team as well as the actual product. So we're probably not going to buy the first loan off of a platform. We're going to want to see the origination and the performance of that origination for a little while, right?
Yep.
So you got management, you got performance. Hopefully there's been some revisions along the way, kind of shows that, you're learning from that origination and you're applying that learning. Capitalization is obviously very important, what's your staying power and, how well you're capitalized and how far is that going to take you? Self-funded, outside funded, all that kind of stuff. And then just, monitoring it and seeing if it lives up to what we think it's going to be. So, Fund That Flip was one that we applied that formula to and met the standard. We started small with you remember, and, we worked out a few kinks here and there operationally, and then everything started to move very well.
Yeah, and I think I got to meet Val probably 2 years. Who's another partner, or I'm not sure if he's still with the firm. I think he's still there with you guys.
Yep.
Maybe in a different capacity, but I think I met him even 2 years before you guys started getting involved seriously on the platform. So there's a good amount of getting to know one another and at least tracking us from afar before we got to where we're at today. So again, I think that's something that not sure everybody that invests on the platform on a kind of an individual basis totally appreciate. So appreciate you sharing that.
Sure. And then, Val and many others, we've got a lot of good industry connections, and we're always paying attention, trying to hear who's doing what and what's interesting and what we should be paying closer attention to. So that's all part of just, being in the game and doing it on a day-to-day basis. And, you guys are not unique in the sense of having a retail platform and sort of an institutional whole loan side. I think that's fairly common. That's something we see as good business to have a diversification of clientele or types of clients, if you will. So, we being where we sit, we're kind of agnostic to that. We're really just looking for the best opportunity, best risk reward for whatever is being offered. So I think we sit in a really good position to help you to offer, both types of products, and sometimes we can help you specifically on an individual loan basis on that as well.
Yeah, it's a great I think place in the market that you guys fill in terms of anchoring investments while still creating opportunities for the retail individual investor to participate alongside and benefit from a lot of the due diligence and other kind of won't go as far as calling it an audit, but you guys check in with us pretty frequently on a number of things that are important in terms of doing your fiduciary duty, which we're happy to provide, and I think everyone benefits from that. So it's good stuff. I think it's very, very healthy for the ecosystem, not just for us, but for everyone. All right, so cool. So I get asked a lot by investors when I talking to them on the phone, individuals, and they always want to know, like, what's your best open investment right now? And it's an interesting question, one that I can't answer for a lot of different reasons, oftentimes. But I think one of the reasons is, best in a lot of ways is subjective in terms of, what's important to you for what are you trying to optimize around, right? Are you trying to optimize around return, risk-adjusted return, geography, a number of different characteristics that ultimately will drive the real return of the investment that you're about to make. So what I like to do is try to help people look at some of the different things from LTV, LTC, scope of project as a percentage of the purchase price, the geography, the overall kind of return, credit score of the borrower. There's a number of different things I think that ultimately, correlate in some form or fashion to risk. I'm just curious from your guys' perspective, what are you looking for? Are there any kind of like lines you won't cross? What's kind of, if you're taking a quick look at something, what are the first few things maybe that you're looking out for, and how can maybe other people that are listening kind of apply some of those best practices to their individual strategies?
We definitely apply sort of the pragmatic approach to portfolio management, be it whatever type of asset you're managing. There's tenets that you basically always want to stick to. And one of those things is discipline. So, we have a buy box that we stay within, things like 75% LTV and, first lien only. There's 6 or 7 things, and we try to keep it as simple as possible. There's a lot of people that, probably get too fancy with it, or sort of curve fit, if you will, quote unquote, their strategy. And you got to be wide enough to be able to see a lot of product. But you got to be specific enough to where it'll achieve your objectives, obviously. So we're really good at discipline purchasing and monitoring. We are also focused, I think, uniquely on a nationwide footprint. So part of the reason we have multiple originators is to kind of cover the entire U.S. Because as you tend to have kind of a regional focus as far as your origination goes. And we also have a mandate for property type diversification. So we're looking for we're looking for residential, we're looking for multifamily, and we're looking for commercial type properties. And we're really equally emphasizing them. We feel like we have that opportunity to where if part of the marketplace, either property type or geography, is stronger or weaker, we can start to emphasize or de-emphasize. And so far, we haven't had to do too much of that. It's been a very good market, but we have enough flexibility in our mandate to be able to add some value in that regard too.
Gotcha. And then are you guys in terms of, because that's kind of where I was going next with this, the your portfolio construction, thesis or philosophy nationwide, which is great. Are you primarily focusing on like major MSAs? There's a lot of talk, in the real estate world around, following the smile, if you will, right? From Boston down through Florida and then back up around the West Coast. Are you doing stuff in, call it, I don't know if Detroit's a good example, but Indianapolis or KC or Denver? You touch on some of these, Midwestern markets as well. And how do you guys feel about those markets?
Yeah, no, it's kind of interesting you say that, because we are, of course, beholden to what gets originated, right?
Yep.
And so of all of our originators and everything we see on a daily basis, it does largely follow that smile. I would say sort of the 80-20 rule, right? So the other 20% is a smattering of everything else. And, I think that's a good thing. I think it's a good thing to have loans outside of that same geographic area or that, same property type that, give you just a little extra diversification. We'll see, if it adds a lot of value or not, in tougher times, but I don't see why it wouldn't. We don't stick to primary MSAs just to answer your question specifically. We'll look at everything, but of course it's a factor, right? It's a consideration. I think if you look at our portfolio, you'd see, concentrations in major areas, but we like markets like Seattle and Denver and, the upper Midwest, the Ohio's and, the Atlanta area. I mean, and one of your favorites recently, the Philadelphia area, right? I mean, These are really nice markets that we still get a little extra value that aren't completely as tight as some of those others. So I think it's a give and take, and you just have to weigh those plus and minuses and make sure you got them in the right proportions.
Got it. Okay, cool. What about, this is another question that just came to mind as you were talking. Do you guys have a perspective on, and does it influence how you think about either your LTVs or LTCs or even kind of the rates that you'll go into on judicial versus non-judicial states?
Yeah, so judicial, non-judicial does play a factor as to what kind of rates we expect. We are not mandated to be just judicial or non-judicial. We hold both. And so, again, it's just like everything else. It should be reflect the rate should reflect all the risks. Yep. And that's another reason why we like this space. Everybody pretty much does risk-based pricing, right? So it's already a component of the underwriting, and usually we aren't second guessing that. Again, we are monitoring everybody's performance, and if somebody's really underperforming, that's when we second guess, right? So when we invest, early due diligence is giving us the confidence that what's coming through to us is quality paper. So that's really the main component of it. We'll watch those trends of performance, but we'll also be paying attention to relative pricing. Sometimes we'll go back and say, we feel like, this might be a little bit light. And sometimes we get opportunities to get a little extra yield from time to time from those conversations. So that's the way we look at it.
Got it. And I should have probably I'm going to do this in backwards order, but for everyone that's listening that may not be familiar with judicial, non-judicial, it's the way that an asset can be repossessed. Either in a judicial state, the foreclosure process requires that you go through a court system, whereas a non-judicial state allows the foreclosure to happen largely without a full going through the courts, and the difference primarily revolves around how long it takes to actually get that asset back and get to liquidity. So we get this question a fair amount from investors around, I really like the judicial states versus the non-judicial states versus the judicial states, and it's a fair point, but I think you more eloquently said it than I could have around that may be true, but to the extent that it's being priced for, and you feel that you're getting a fair price for that additional risk or potential that longer kind of hold period to liquidity, maybe it's not a terrible thing.
Yeah, exactly.
Very cool. So we're going to get you out on this last question. I really appreciate you sharing all these insights up to this point. But if you had, you guys have done, hundreds of loans, maybe probably thousands of loans, I guess, up to this point over a number of different years. I'm sure you've learned a ton in terms of what to do right, what to kind of avoid. If you had one bit of advice for the person that's listening out there in terms of, they're developing their strategy, what would that one piece of advice be?
Yeah, I would say stay disciplined to what you're trying to achieve. You can really second guess in any asset class, right? You can really think that you know more than the market, or you have this insight on this type of property and this type of location, whatever. I think you just establish really good parameters that you're comfortable with, and you stay within those. And you get the proper diversification within that construct, and the risk will take care of itself, and the returns, of course, will take care of itself. So I think our disciplined buying has really been at the root of our success. I think that is a function of who we are here, as risk managers, effectively, and understanding that you stick to your knitting. And only after lots of research on the topic, where you might see a trend or might see an opportunity outside, you got a lot of research where you might be able to incorporate something new to that discipline. Just stick to it, and I think that's a great takeaway.
Yep. Could not agree more. Develop a strategy, and again, kind of each person's strategy is going to be slightly different. But once you have that strategy and you've built your own box, stick to it. Don't waver from it. I love it. Well, this is really great. I'm going to try to summarize this a little bit here for us. I think one of the first points that was well made is, that having an institutional investor investing alongside our retail investors, I think, brings a lot of value to our platform and is overall very healthy for the system. So I thank you guys for doing that for our
it's been our pleasure.
Yeah, the overall, I think, industry benefits a lot by having folks like you involved in the space. So that's awesome. You had discipline in here a couple of times, but I could not agree more on, finding that strategy, sticking to it. And it doesn't mean you can't adjust, but those adjustments should probably be founded upon a totally revised strategy rather than on a one-off basis. I think the last one was the idea around, make sure you're getting a premium return for potentially some additional risk you're taking. So whether that's going into a judicial versus non-judicial state or a higher LTV or LTC, we try to do a very good job of this. I'm sure a lot of other platforms do as well, but all 65% ARV loans are not created equal. There's a lot of other things that go into that. So take some time to understand, what the other levers are that are driving risk, and make sure that, on a apples to apple basis, you're getting compensated accordingly. Those are my takeaways anyways. Hopefully you all got some of your own as well. So Peter, this was great. Really appreciate you stopping by and talking us through how you guys think over at Prime Meridian. And again, really appreciate everything you guys do for the industry as a whole. Super insightful stuff. So thank you very much for sharing.
Oh, thanks for having me, Matt. I enjoyed it.
Great. And for those of you who are listening, feedback is what makes us better. So if you have any ideas for what you'd like to hear on future shows, please let us know. Also, and we'll link to this on the page on our blog, Peter mentioned developing a strategy and then, creating some discipline around sticking to that strategy. We put out a white paper a while back that, helps particularly new investors think through developing that strategy. So we'll be sure to link to that white paper on the blog. So check that out if you haven't seen it already. And otherwise, check out the blog. There's a lot of great content. Otherwise, look forward to having you join us next week for the next Investor Insights. Thanks for listening. Until next time, this is Matt signing off.